Hello friends. So friends, we are going to continue with our topic of ratio analysis, right? And in the last lecture, we started with activity ratios. I told you what are activity ratios. Activity ratios tell us about the performance of the business, tell us about the efficiency of the business, right? Efficiency about what? Efficiency about the usage of the various resources of the business. Clear? So, activity ratios talk about the efficiency of the business, they talk about the effective usage of the various resources of the business. So, activity ratios talk about the effective usage of the various resources of the business, right? Then we started with the first activity ratio, that is inventory turnover ratio. So what is inventory turnover ratio? We discussed this in detail, that in a particular year, how many times you are able to convert your inventory into sales. Convert inventory into sales, right? And subsequently you are able to recover the cost of the goods that you have sold. Cost of goods sold. Clear? So inventory turnover ratio tell us that in a particular year, in a particular period under consideration, how many times you have converted your finished inventory into sales. So if you are converting your finished inventory into sales, that means you will recover your cost of goods sold, right? I explained you this in detail with the help of an example in the previous lecture, right? So what we are doing? We are recovering the cost of the goods sold, right? So what was the formula for inventory turnover ratio? Cost of goods sold divided by average inventory, right? So this is always in times, that how many times you are able to convert your inventory into sales, right? Now after that we discussed about how to calculate cost of goods sold. Now why I am repeating all this? Because we will be using this in the practical problems in this lecture, right? What is cost of goods sold? If you first calculate the total revenue from sales, from operations, right? And if you remove the profit element, from the revenue from operations, what you will get? You will get cost of goods sold, right? Whatever you have earned a profit in that. If you remove the profit element from that revenue, what you will get? You will get the cost of your goods that you have sold. Clear? Or the another method of calculating it is opening stock plus purchases plus if there are any direct expenses given minus the closing stock. Whatever you will get is cost of goods sold. I explained you this with the help of a trading account, right? Clear, friends? Now one thing, what are direct expenses? direct expenses are any expenses which are incurred in procuring the material till the material reaches your factory premises. So what are direct expenses? Any expenses which are incurred in procuring material till it reaches your factory premises. Right? So any expenses that are incurred right from buying the product and from bringing the product from the original position to your factory location. Any expenses during this period, they are the direct expenses. Clear? So this is how we are going to calculate the cost of goods sold. So another element in this is average inventory. Average inventory held during the year. Average inventory held during the year. This is opening stock of inventory, opening stock plus closing stock divided by 2. Right? This is going to be your average inventory that is held during the year. Clear, friends? And this is what we are going to study, the relationship between cost of goods sold and the average inventory, which shows how many times in a year you are converting your inventory into sales. Right? If you are converting your inventory into sales, that means you are recovering your cost. Your cost of goods sold will go up and your average inventory will go down. Right? Clear? Average inventory will go down and your cost of goods sold will go up. So higher the ratio, the better it is. Clear? So friends, let's start with the practical problems. Okay. From the following information, calculate inventory turnover ratio. Cost of revenue from operations, or you can say cost of goods sold, 4,50,000. Inventories in the beginning of the year, 1 lakh. Inventories at the end of the year, 1,25,000. Clear? Very simple question. The two things that you need: cost of goods sold. It is already given in the question as 4,50,000. The second thing that you need is average inventory. It is opening stock plus closing stock divided by 2. We are given the opening and the closing stocks. Opening stock is 1 lakh and the closing stock is 1,25,000. So I'll say 1 lakh plus 1,25,000 divided by 2. This comes to rupees 1,12,500. Now you can calculate the inventory turnover ratio, that is cost of goods sold divided by average inventory. Right? What is cost of goods sold? 4,50,000. What is the average inventory? 1,12,500. This comes to 4 times. This is the number of times that you have been able to convert your inventory into sales, and you are able to recover the cost of the goods sold. Clear? higher the ratio, the better it is. Right? This was a very straightforward question where you were given the straight information. Right? Let's do the next question. Following is the statement of profit and loss of EXE Limited. Calculate inventory turnover ratio. Statement of profit and loss for the year ended 31st March 2016. He says revenue from operations is 2 lakhs. Right? Expenses, purchase of stock in trade 1,20,000, changes in the inventory of stock in trade 20,000, other expenses 30,000, total expenses 1,70,000, profits before tax 30,000, tax 5,000, and profit for the year 25,000. Clear, friends? This is the profit and loss account basically that we are given, a statement of profit that has been given to us. Right? Now, they have given the notes to the accounts also, that change in inventory of stock in trade. How they have calculated this change of 20,000. They say the opening inventory was 40,000, closing inventory was 20,000. So, our change in inventory is 20,000. Clear? Then say the other expenses of 30,000, they include carriage inwards of 10,000, carriage outwards of 12,500, and miscellaneous expenses of 7,500. Clear? Now what you have to do is you have to calculate the inventory turnover ratio. Now you need two things. The first thing you need is cost of goods sold. What do you need? The cost of the goods sold. Now how you will calculate? You are given the purchases of stock in trade as 1,20,000. You are given the opening inventory of 40,000, closing inventory of 20,000. This lead to change in inventory. If we write down the formula, this is opening stock plus purchases plus any direct expenses minus closing stock. Right? So now what is the opening stock? Opening stock is 40,000. So you will write it as 40,000. Right? Plus purchases. You are given the purchases of stock in trade 1,20,000. Now comes the direct expenses. You are given three expenses: carriage inward, carriage outward, and miscellaneous expenses. Now can you tell me, out of these three, which are the direct expenses? I told you direct expenses are any expenses incurred in procuring the raw material and bringing it to your factory premises from the seller premises. Right? Carriage inward, that is the freight paid. Right? Freight paid while bringing the material to your factory premises. Carriage outwards. Now carriage inwards, it is a direct expense or not? Yes. Any expense incurred in bringing the material to your factory premises is a direct expense. So carriage inwards is a direct expense. Carriage outwards. Outward means any freight paid on the sale of the goods. Does it come under direct expense? No. Miscellaneous expenses of 7,500, until and unless not specifically given, will not consider them as direct expenses. These are the indirect expenses and these will be considered in profit and loss account. Clear? So what is the direct expense out of these three? The direct expense is only the carriage inward part, 10,000. Direct expense 10,000. This is carriage inward, right? Minus closing stock. What is the closing stock? 20,000. Clear? So this comes to the cost of goods sold comes to 1,50,000. Clear? Now the second thing that you require, is average inventory that is held during the year. This is opening stock plus closing stock divided by 2. What is opening stock? Opening stock is 40,000, closing stock 20,000. So this comes to 40,000 plus 20,000 divided by 2. This comes to 30,000. Now you have got the cost of goods sold. Now you have got the average inventory. You can calculate inventory turnover ratio. This comes to cost of goods sold divided by average inventory. What is the cost of goods sold? 1,50,000. Average inventory is 30,000. So this comes to 5 times. Clear? So now you have understood how to calculate the cost of the goods sold. Opening stock plus purchases plus any direct expenses minus the closing stock. Right? If you are given the change in inventory, the change in inventory means the opening stock minus closing stock. You are given the net figure of 20,000 like you are given here. This change in inventory and stock in trade. You are given the net figure of opening minus the closing. Clear? So you have to be careful about this. So friends, this is about the inventory turnover ratios that tell us that how many times in a year we are able to convert our inventory into sales, and thus we are able to recover the cost of goods sold. Clear? Now, in the next lecture, what we are going to study? In the next lecture, we are going to study the next activity ratio, that is trade receivables turnover ratio. Right? So in the next lecture, we are going to concentrate on the new ratio under the activity ratios, that is trade receivables turnover ratio. Clear? So friends, if you have any queries, just send me an email at ksjteaching@gmail.com. Right? So that's all for this lecture, friends. Thank you so much.